Hey, listeners, welcome back for another live version of your Smart Retirement Podcast. Mike Points here, your co-host. I'm here with my esteemed friend and co-host, Matt Hollander. What's happening, Matt?
What's going on, Mike? Trying not to, we kind of skipped spring out here in Scottsdale. It's really interesting. We had like 70, 80 degrees. We had like 2 days with 80, and now it's like up in the high 90s. I'm just like, okay, I would have liked another month of like some 80s in there, but the pool's starting to get warm, so got some new patio furniture, and man, patio furniture is expensive.
It really is. They've kind of got you in a pickle, right? Where you want to be outside more and you need to stretch your living space, and there's really not that many games in town. If you want to get it quick, it's a fortune. If you're willing to wait, which is rare because people don't really spend that kind of money until they're like, I want to use it today, then you can get a bit better deal, like if you go on Costco.com or some of these online vendors.
Yeah, I actually ended up getting a lot of the stuff from Costco.
Right.
But, it's taking 3 to 4 weeks for it to come in. It's funny. We live in that generation now that, like, you go on Amazon and you can't have it in 3 days. You're like, I don't want it then.
People feel the same way about loans. They're like, hey, when are we going to close? I just gave you all the documents yesterday. I'm like, well,
it doesn't quite work.
Kind of an underwriting process, and those people have like other loans that they're doing too, and we haven't figured out the robot underwriter yet. Yeah. Some banks will tell you that they have, like the ones that launch rockets. And then you'll get right into like the week before you close, and they'll say, "Hey, I'm sorry, you need to bring in another $60,000. The income we used isn't accurate." Or so I would rather take longer and be right. But I do think I'm plugging myself here. You're right. I was in the attic yesterday, realizing that the attic light bulb went out, and I ordered a light bulb in the attic on my knees from my phone. Right. It's probably shown up today or something crazy.
Yeah.
But yeah.
We got same day delivery here in Phoenix because we've got a huge warehouse here. So
right.
If it's luckily here, boom, we've got it. So,
yeah. Well, listeners, we want to kick off part 2 of our 3-part series. This one's great. It's basically thinking like a retiree when you're in your 40s and 50s. So the message we're trying to help you focus on during this series is little tips and tricks that don't seem really prudent to get on right now, but allowing yourself time to let these things really grow into valuable assets, extremely good tools to either retiring earlier, maybe just retiring better, or smarter, if you will, and also retiring with some certainty, because I think a lot of people out there, maybe they started in the employee world, but then they quickly saw that they had some skills that they could be compensated for if they went self-employed and became a contractor. And now they're right in this limbo where, like, the last 3 or 4 years, I've been just thinking about cash flow. Now the business is going well. I haven't been retiring for 3 or 4 years. What do I do to catch up? And actually, we got a call in from Craig, actually one of our listeners out in Cleveland, Ohio, and he said, hey, I'm 38 years old. I basically started a business in my mid-30s, and I need to start a barometer. Matt, this question's for you.
Okay.
What is, considering my age at 38 and knowing, I won't share all of Craig's background, but he's basically said, I've had a gap in retirement planning because I needed to make sure the money I had was able to help the business operate. What should I have, just simple, in retirement now to see that I've got like an A grade at getting there? Which is such a, double-edged question, right? Like, what is getting there? There's all these things you could easily combat me at, Matt, but just kind of generally speaking, if you were on a golf course and this guy was about to tee off with you, what would you tell him in a couple seconds?
Sure. Yeah, I mean, we could have a whole show just on this and the ideology of, there's so many different ways to really do that, right? But I think at the end of the day, I was looking around online a little bit, and Ally Bank had actually made a pretty good article that talks about saving, through your 20s, 30s, 40s, 50s, and gives you an idea of exactly that. Okay, a chart they have on here. I'm going to reference the chart, but for this listener, at age 40, so he's 2 years away. They say that you should have 3 times your income saved.
Okay.
By age 40.
Okay.
So age 50, or look at 5 times. Age 60, 7 times. Age 70, 9 times your income. Now, this is very much a general way of looking at it, because it really boils down to how lavish of a retirement are you looking to have? What other sources of income are you going to be having that come in, right? So you're going to want to make this money work for you in some way or another that you can draw from and take income from it. But then also, what's your Social Security like? What's that going to look like? Is it going to be around, right? For some of our listeners, we don't know.
2034 is the year, right?
Yeah, I mean, they're going to have to figure something out there. So, and I imagine they will. I don't think it's going to ever be one of those things where they're going to say, hey, we're just not doing this anymore. But I do think there's going to be some changes coming into that, as far as probably the full retirement age being pushed back, and maybe reduction of benefits, which, really stinks for a lot of these people that were looking forward to that when they, would go claim Social Security.
So you're saying income, some of our self-employed guys like Craig from Cleveland is probably strategically planning, writing off things. So if his income's only $36,000, Craig, what Matt's really talking about is like the income that you use for your personal budget, right? Your personal budget can be different than what you report to the IRS or your state franchise tax board, not because you're being, unethical or fraudulent, just because you don't really apply tax code to your budget. So if you're living off of an income that you see, okay, $70,000 a year helps me run my house, utilities, I have grocery money, that in your 30s you should have 1 time your income in retirement. Okay? So not terrible. I mean, if you're like at 50 and you need to get to 70, you're not getting an A in this class, but you're getting a B minus, right? And so what Matt's going to do in this right after the break is give us some great ideas on, hey, how do I get there intelligently? If I'm being a smart retiree in my 40s, if I'm going to pat myself on the back, my 58-year-old self today, what are the ways to start the building blocks? Because I can't go out and trade options and, buy a business and own a commercial building unless I'm a Rockefeller. I have to start simple. It's like eating an elephant. So Matt's going to get into that in the second half of our show. I'm going to probably talk really quick today because I have limited time. I'm getting on a jet plane tomorrow to go to Virginia. I've prepared less than Matt has this week, but Matt's got some great stuff to talk about. Also, I want a testimony to all you listeners. What Matt's recommending today after the break, I've actually put in place in my own personal finance plan. I've seen it work wonderfully already with my spillover buckets, which he'll talk about, like the difference between how much I put in my 401k, and I won't spoil it for you, Matt, but I wanted listeners to know that what Matt's recommending today, I've actually done myself through Matt, and I've been very pleased.
And listeners, real quick, Mike, listeners, if you're, in the same boat, you're trying to figure out, hey, am I saving enough? What's that going to look like? If you want a more in-depth projection on that, I'm happy to run a income plan for you to give you an idea of how you're tracking and what you can do to help pick that up. So if that's something of interest to you, 866-53-RETIRE. Again, that's 866-53-RETIRE. Or shoot us an email at info@smartretirementcast.com. So, Mike, what do you say? We take a break, and when we come back, let's have some fun with it.
Let's get it done.
Oh, stick around. We'll be right back.
We're back from that break, and I can't tell you how excited I am to let Matt talk about this. Again, I've gone ahead myself and taken Matt up on this advice. It's been about almost 2 years now, and love the fact that I have what he's going to talk about in place. It's just one of those things I needed to have a discussion with a professional because I was in my late 30s and I felt like I was falling behind in retirement planning, and he just kind of laid it out for me in a refreshing way. This doesn't cover everything I need, but it's a big segment of like what we talked about in, the wealth triangle, episode 16, where we talk about building a base to protect yourself, but also having the right plan in place to start the little things in retirement.
Right.
Matt, I will let you take it away from here. Just do us a favor. When you can, make sure you don't take us through all of this exciting stuff, because we got to save some of it for part 3, right?
Yes.
Yeah,
Absolutely. So
yeah.
I guess where I want to start today in discussing is just the idea of having a diversified portfolio is extremely important, right? And that's the one thing, when people we're talking, I mean, that's the first thing we're going to cover is, making sure that you've dotted all your I's, crossed all your T's, and you're having a little bit of money in different places, right? I mentioned this in part 1, but people are running out of the ability to have pensions and things at work, right? So you're really going to have to be aware of that and plan early. And compound interest is your best friend. And the sooner you can get started on something like this.
Totally agree with that. Totally agree with that.
So, I mean, one of the things that it's just like a no-brainer, easiest thing that, we talk about doing is you've got your traditional 401k or traditional IRA. The 401k is going to have higher contribution limits than an IRA, of course. And it's going to have less options usually available inside of it. But the one thing you sometimes will get with a 401k is the ability to have your employer match the funds that you're putting in. And, that's going to vary based upon the employer. But let's say you wanted to put in 10% of what you were bringing in, but your employer is only matching 6%. So it makes sense to then take the full 6%, because essentially that's free money from your employer. And then maybe look at taking the other 4% and contributing it into a Roth 401k. If you have that option available to you at work, I would strongly suggest it, because when we're looking at diversification, it's not only being diversified as far as assets, it's diversified in the tax status of these assets as well. So the money that's going into a traditional 401k or IRA is able to be written off on your taxes at the end of the year, or as a Roth is not. But the benefit of this Roth now becomes you put the money in, you've already paid taxes on it. When you go to pull the money out, it will be tax-free, and it grows inside the account. It's absolutely tax-free. So, what am I saying there? It makes sense, because later on, as that asset grows over time and you want to take income from it, it's going to keep your taxes low in retirement, and that's key, because we don't know what's going on with taxes on a day-to-day basis. So,
So in many accounts, so like if you see someone, I know you look at, like you mentioned before the break, you're willing to look at people's asset accounts with them and help them give them a retirement review. How much of the portfolio is initial principal versus actual growth? Like how much, if you look at, let's say they have $100,000 in there.
Okay.
And they've been saving it for 20 years, 15 years.
Mm-hmm.
You're getting most of your clientele a little late, where they're like, hey, we're really behind. You're not getting them in their 40s and 50s unless you're going and talking to someone that's set an appointment with you based on a referral or something.
Correct.
So of $100,000, how much of that is the actual money they put in after tax to a Roth, and how much of it is the growth part? Is it usually 50% or more is the actual growth that's built over time?
It's hard to say, right? I mean, I don't know what it's invested in. It still has market risk, so depending on when we look at it, right? It's hard to say.
Well, what I'm trying to say is you're mentioning the fact that this money grows and compounds in its growth year after year after year, tax-free. Mm-hmm. So even if you dumped $15,000 in there once, it would grow for 20 years.
You would think. Yeah, right. And depending on what you had it in, maybe you bought like an S&P 500 index fund or something, right? And if you look at that on a over the last 20, 30 years. I think it's about 8.2%, 8.3%. So yeah, you put in 15 grand and at 8.3% over 20 years. I don't have a compounding interest calculator in front of me, but yeah, of course it's going to do that. But you are going to have some years that you're going to have some market volatility, which is kind of why yes, I really enjoy the Roth products, and I see a niche for that in everyone's retirement. But also looking into, like the product that we've done for you, Mike, is looking into a thing called fixed indexed universal life insurance. And indexed universal life, don't think of it as just life insurance, okay? Essentially what's happening is the insurance companies have created a way where you, the individual, can add money in on a monthly, annual, however you want to do it basis, kind of like a little savings account. And it's growing over time based upon, if you do a fixed index universal life insurance policy, it follows an index, like an S&P 500. There's hundreds of different indexes that these insurance companies use. The S&P 500 is usually the most easy to track and follow, of course.
Yeah.
But what will happen is the money goes in, you're going to pay for some of the insurance, right, because it does have a death benefit associated to it. But it's really more of an accumulation-focused product that we're going to utilize later in life for income. And I'm not sure which episode. We did one with a guest, Chris Foley. Mike, do you remember the episode number?
Yeah, that was episode 28.
Okay.
What's better than cash? Cash and a death benefit.
Exactly. So essentially what these things do is money goes in, grows over time, compounding, and then at the point of time that you decide to start taking income from this, you're essentially borrowing against your own death benefit in the policy. And by doing that, you're not actually pulling money out, you're borrowing it on a loan from your own self, a loan that you'll never have to repay because the death benefit pays the loan off. But it's tax-free. So,
yeah, because it's not income.
Right. You're borrowing your own money, right?
Yeah.
And
yeah.
just like in most, well, all life insurance policies, the death benefit when it goes to the heir is tax-free. Now, all you're doing is taking advantage of your own death benefit now, or in 20 years when you decide to use this product, right?
Okay, so you got a living benefit and a death benefit.
You got it. And what's really cool about these things is if you set them up early enough, like I did mine when I was in my early 20s, I basically contribute for X amount of years. When my son's ready to go to college, I can turn on some income now to help supplement the income to pay for his school for the 4, 5, 6, wherever many years he ends up going. And then I can turn it off, and it'll continue to grow again for when I'm ready to do it, when I retire. Okay, so they're flexible in the sense that you can do just about anything you want with turning on and off income, how much income you want to take from it. That's all can be changed. The one thing that cannot be changed, and if you've ever heard of a MEC or modified endowment contract in a life insurance policy, what happens is you can't overfund a life insurance policy. So essentially, when you open it up, you say, Matt, let's put in $5,000 a year. Okay, $5,000 a year it is. You can't go and then the following year put $10,000 into it. The IRS looks at that as overfunding, and it will then become a taxable account. The death benefit would still be tax-free, but when you start borrowing things from it, you will not get the tax-free advantage that you would have if you would have set it up correctly. So, you can have more than one of these things. So let's say you start one when you're in your 20s, 30s, 40s, and you start making more money in your 60s. Well, you just open another one at that point in time, assuming your health is still good, because you are going to have to pass a health exam and physical. They'll come to the house, draw blood, do all that fun stuff. So the other thing that you can look at on the universal life side is they have something that's called a variable universal life insurance policy. So the difference between the two is a fixed index doesn't have any market risk. So that money's going in, you're following an index, and you're not getting 100% of whatever the index does. The insurance company might take 20% right off the top of the return on that index, but what they're doing is on the backside insuring you of any downside loss. So yes, you still pay the fees for the insurance inside of it, but you don't have any loss of principal at any point in time. Whereas in a variable universal life policy, you're essentially buying inside of the insurance policy. They have options that are called sub-accounts. And a sub-account is going to have like mutual funds, if you will, inside of it. They're kind of like a mutual fund, but you get 100% of the upside, but you get 100% of the downside as well. So fundamentally for me, if I'm trying to set something up like a pension, I don't want to have that worry of what's the stock market going to do and have to be concerned whether or not, my account's going to be able to be there when I want to take it when I retire in 30 years. This is like that safe money stuff. It's a pension. So, hey, let's put the money in on a fixed index basis so you can track an index, don't have any downside risk. We can make some estimates based upon what the market's done in the past and get a pretty good idea of how much income they're going to be able to guarantee for life. So if that's something of interest to any of you out there, feel free. 866-53-RETIRE. Again, that's 866-53-RETIRE. Happy to run you a quote, let you see what that might look like. Any amount is okay. If you want to do $100 a month, that's fine. I'll run it so you can see it. And you just see, even at $100 a month, if you started that, let's say you're in your 20s, I mean, that policy is going to be doing pretty good by the time you're 65, 70 years old and wanting to start withdrawing from it. So,
yeah, I mean, so at the age of 38, I started doing $400 a month. And by the time I'm 58 and a half, so 20 years later, I'll be able to take out $1,600 a month tax-free, almost $1,800 a month, tax-free, with no penalties, no nothing until I'm like 95.
Yeah, so here's the thing.
But that could run out, but so it's not like for 3 years. It's not like, you can have a nice little buffer as you go into retirement. No, I'm going to use that to make sure I postpone taking Social Security. I'm going to use that to offset the fact that I'm probably going to not be working as much at 58. That's my goal, is to be half retired at 58, where I'm literally like golfing 2 days a week. But don't worry, clients, that's 17 years from now. But I do think that one of the things you didn't touch on, you talked about a cap on life insurance policies, but what are the general caps on like 401ks and Roths? So like if someone has $30,000 a year that they want to allocate to this stuff, what is the cap on a Roth right now? Because I know that moves every year.
It does. I'm pulling it up right now. So 401ks, for the Roth 401k or a traditional, it's going to be $19,500 a year that you're allowed to put in there. And then on the IRA side of things, less. So in the IRA side, if you're under 50, you can put in up to $6,000 a year into a traditional and $6,000 into a Roth. If you're older than 50, you get an extra $1,000, what they call the catch-up provision, and so it goes up to $7,000 a year you can put into that. The life insurance policy, there is no limit, right? We just have to make it something that you can sustain for a period of time. So you don't want to make it too small, don't make it too big that you're not going to be able to afford it, in any given year. So you kind of want to base that and kind of look at your income in a whole and figure out, okay, I'm already contributing some to my 401k, so now I'm going to follow Matt's advice. I'm going to take some of my 401k stuff, go to the Roth, put some money there, and then now let's look at base on, that, what's left over, and let's take a percentage of that and put that into the life insurance policy.
Right. And then here's what's great about, and I'm going to segue Matt into my piece now, if you don't mind. Here's what's great about Matt working together with you. We're kind of like yin and yang, or, Batman and Robin. Of course, I'm Batman. But
thanks.
What is really happening here is, you might discover, hey, I've got $1,000 that after I pay my budget down, have my obligations met, put money aside in my emergency fund, I've got $1,000 that I want to use. I'm already not factoring in the match from my employer. Like, I don't consider that in my budget. And if you're smart, you're doing that. You're saying my budget is take-home money, and I have a match set aside that I'm capping out as much as I can.
Yep.
And then with that take-home money, you're now saying I've got $1,000 left over. Matt might help you find a way to achieve your goal with a life insurance with $300, $400, $500. I can then sit back and show you, hey, if you put $350 a month towards this personal liability, you're going to have that thing paid off in a year and 9 months. And if you continue to put that personal liability, let's say it's a car loan for $400 a month, This is what's called the snowball effect. You can look this up. I didn't create it, but Dave Ramsey himself talks about this a lot on his show about being debt free. But with that $1,000, Matt can now have you properly starting your retirement for tax-free income. The employer's matching you on the fun stuff that grows in the market. Matt's got you in a more secure, like he said, you could do it indexed or non-indexed. And then I'm giving you advice on ways to pay down this debt so that you free up cash flow that you could start next year putting in with Matt, right? Up to the amount we make. Or now you've got $600 left over after a year and a half. Guess what? Let's put that towards the mortgage. Let's find a way to get that mortgage paid off at 58 as well. If you have the ability to take out tax-free money up to $2,000 or $2,400 a month, and now you don't have a $1,900 a month mortgage payment at 58, that's equivalent to someone that's making $6,000 a month and taking home $4,400. So after taxes, that's basically a $72,000 income. Right. You've freed up cash, you've freed up liabilities, and you've created this tax-free income. So IRS is not going to touch it. Guess what? If you don't want it one month, you just leave it in the reserve account. It continues to grow. And if you should pass away prematurely, Matt's got your family's back on the life insurance policy. So this is a great way to segue from the guy that's saying, oh, I got $10,000 in a Robinhood account and I'm looking at stuff, planning for my retirement. Hey, that's what we call funny money. That's good. That's a good use of your time. I like your mind in the market, kind of feeling where the economy is going. You have to be plugged in to do that, to do it right at least. Or you could just lose it all. But this is the stuff that really starts the building blocks. You guys want to go back, you listeners want to go back and listen to our Wealth Triangle series. Starts at episode 16, 17, and 18. Look those up in our episodes. You can go to smartretirementcast.com. Episodes, its own page. This is episode 47 we're at. We're almost at episode 50, Matt.
Whoa.
I know.
Crazy.
And then the other episode that we referenced earlier in the show is What's Better Than Cash and a Death Benefit. That's episode 28. Check that out too. Listeners, Matt's not joking. He wants to do these one-on-ones with you, these account reviews. 866-53-RETIRE allows you to get to Matt. I like to come in this situation. If he does a retirement review, I would just come in behind him and say, hey, look, here's a couple of things I would recommend. Either your mortgage is way higher than it should be. What's your plan with this house? Are you going to make it a rental property? Are you going to move up in a couple of years? Let's address these personal items now that are like higher car payments, higher personal loans. Here's how you can afford to get the move-up house. Let's put you on a 12-month plan. Let's pay off these liabilities. Let's take a 401k loan to pay off these liabilities so that you qualify for a bigger house, and the loan can be a repayment to yourself through your paycheck. Really neat stuff. We're here to help you with all of it, kind of put it all together. Matt, I wanted to just thank you today for going into detail on that. I wish we had the time to go into like minutia, but I know listeners are going to want to see you online. But wait, they can, right?
Yep.
We have an online YouTube video as of this year, since January, early February or late January. We started recording all of our shows you listen to on our own YouTube channel. Matt, help us with the YouTube channel.
Yep, so pretty easy. Just when you go onto YouTube, just type in Smart Retirement Podcast. Our channel will come up, and we've got the library of videos up there posted. A couple other videos in there as well. I've got one of me doing an interview with one of our guests that we had on the show, Mark Rogers. That was a good interview that just kind of talks about what I like to do as far as in my business and how we're a little bit different here at the Century Financial Consultants. So but thanks again, Mike, for hopping on. Have a safe trip over to the East Coast.
Ooh, before we go,
yeah,
I know you're gonna say your famous line. I don't want you to say it yet.
Okay.
Part 3 of this series is going to be, we kind of left the best for last, just like they do on the news. We're getting to the best episode right after the weather. But we've got one of your close colleagues that you've worked with before, the Pacific Financial Group. We're going to lock him in on a date and time and record him. We may record before the actual Tuesday showing. We'll see how it goes. but he's from the Pacific Financial Group, and he does self-directed IRA help. So he's a third-party administrator.
Yep.
Tell us a little bit about his name and some stuff you've done with him, Matt.
Yeah, so I'm trying to get Eric Coons, who will be our guest for that, and I've been in the been around Eric now for probably 7 or 8 years in the field. What his company does is he is able to bring in their managed portfolios into your personal 401k. So you, rather than having that 30 or 40 different options that you might have inside your 401k now, they're going to be able to come in and say, hey, you want this money to be just set it, forget it, let us come in and help manage it for you. They'll charge a percentage to manage it, and then boom, you've got opened up a whole new option availability inside this, inside of your portfolio. So I'm pretty excited to have Eric on. I think it will be very informational for everyone here to get to spend some time and get to understand what he does a little bit better. I think it's a good product to have in the marketplace, and especially with some people, I think a lot of my clients I've seen when they have their 401ks, they usually just buy a target fund, right? And that target fund's like, hey, I'm going to target fund retire this date, so it automatically will change the makeup and the balance of how conservative, et cetera, is inside that portfolio as they approach their retirement.
Yeah.
Whereas this is going to be a little bit better, be a little more personalized based upon your actual risk tolerance and things like that. So.
Yeah, but you can get into things that are very, very different. I mean, you can buy into Delaware statutory trusts where you have a fraction of commercial real estate owned. You can buy real estate outright as an LLC. We're going to have Eric touch on that because I think it gives people, and you don't have to do all of your money there, right? You can do a portion, but it gives people that, and if you're already starting to invest and you're thinking about other ways to make money, and maybe your 9 to 5 is something that you are great at and you can focus on just that, but you also dabble in other things, self-directed IRA can be a lot of fun. We're going to touch on that in part 3. We saved that for last for you guys.
Very good. All right, smart retirees, let's go out and make the rest of our lives the best of our lives. We'll see you in 2 weeks.
The opinions voiced in this podcast are for general information only and are not intended to provide or construed as providing specific investment advice. Any economic forecast set forth in this podcast may not develop as predicted, and there can be no guarantee the strategies promoted will be successful. All performance reference is historical and is no guarantee of future results. Investing involves risks, including the potential loss of principal. No investment strategy or risk management technique can guarantee return or eliminate risk in all market environments. Thanks for tuning into this podcast. California license number 0175638, NMLS number 1246224.